the next stage of this AI revolution. It's about the use cases because now the build out's happening. It's not just about NVIDIA chips, but when you look what's happened with OpenAI, you look at ultimately Oracle, Microsoft. I mean, now you're really seeing this multiply. And I believe that will separate the winners from the pretenders. And I think investors, it's a stock picker's market, especially when it comes to tech.
So in terms, and I know you've got your own product as well where you're picking the winners. And are there any obvious names that you see out there that our viewers and your clients say, well, look at the valuations one, and you say it's just not going to be part of the winners? Some of the software players, the picks and shovels companies as well, who are just getting a rising tide wrongly, though.
Yeah, look, I mean, we have the Ives AI 30, and that's something that we're always focused on because it's not just about big tech. It's about in software who are the winners. I mean, look at, when you think about infrastructure, names like GE Vernova, Nebysys, okay, where does CoreWeave fit? You look at autonomous and robotics, which is another area, we think Tesla continues to be front and center there. To me, it's really going to be about the second, third, fourth derivatives as this all plays out. I mean, that's going to be the key. But you talk about pretenders, look, the next 6, 9, 12 months, it separates. I mean, in other words, who executes, where the spending is. And that's how names like Palantir have gone from teenager to, what I believe on track to $1 trillion valuation next 2 to 3 years.
Dan, Palantir, fascinating story. We spoke to the company the other day. I want to get to one of the risks because the industry has become so incestuous. What you've seen in terms of Jensen Huang bankrolling just about every company or partnering with every company on the planet is one or the other. And of course, the biggest one lately has been the Nvidia tie-up with OpenAI. Is this a worry for you, almost like dominoes that if capital markets shut and there's a problem with one of these companies, that it just has blowback right across the whole sector?
Yeah, look, you've seen some of those worries, but see, I look at it differently. I mean, for every dollar that NVIDIA puts in, they're going to ultimately get $10, $12, $15 back, right? In terms of revenue as this build out actually happens. And my view is like, we're only in the beginning. I mean, because you're thinking about only 3% of companies have gone down the AI path just in the US. So think about the international expansion. Think about all the things we saw in the UK. Then you go back over the last few months, Middle East. I mean, this is essentially building Dubai from the beginning. It's building Vegas where there's no buildings, right? I mean, you're building out the new infrastructure. I just don't view it negatively. I view it as just part of the really what's going to be this fourth industrial revolution just playing out.
According to a note by analysts at Bank of America led by Vivek Arya, Nvidia is committing $100 billion to further collaborate with OpenAI. The agreement includes a letter of intent to provide at least 10 gigawatts of AI infrastructure beginning in the second half of 2026. Over time, the deal might bring in between $300 and $500 billion, according to BofA. According to the experts, OpenAI's preferred strategic compute and networking partner will be Nvidia. As OpenAI expands its AI capabilities, Nvidia will contribute money and provide equipment as part of the deal, which combines compute infrastructure and stock exposure. The deal's circularity, funds are recycled back into chip purchases, raises concerns over its long-term structure and accounting treatment. The collaboration is a daring wager on the side of Nvidia that it can change its income profile by providing infrastructure and holding stock in the AI stack. With a high estimate of $310 and a low estimate of $175, the average target price for Apple Inc. is $244.43, based on the one-year price targets provided by 42 analysts. From the present price of $252.31, the average target suggests a decline of 3.12%. The market is still fully committed to Nvidia. For more reasons than just being one of the trendiest stocks on our platform, Nvidia is the stock of the day's opening bid. It's also not because Nvidia announced significant agreements with Alibaba and OpenAI this week. The community's continued optimistic sentiment toward Nvidia stock is the cause. First, there is increased interest in the information about Nvidia as the company's stock price has increased over the last 5 sessions. The chart below illustrates that. That is an excellent indication that investors are researching Nvidia and wish to continue following the market's most significant stock. Second, it is evident from the data below that the community is probably increasing its Nvidia holdings. Why? Investors' study is probably showing that the fundamentals support it. Notably, 93% of the sell-side analysts who follow Nvidia give the company a buy or strong buy rating. You should make sure that your portfolio includes exposure to some of these names, because I do believe there is more opportunity to go in Nvidia and AI trades, Fernandez continued. Early this morning, my friend and mentor Jim Cramer gave me one more piece of advice regarding Nvidia. From a valuation standpoint, the company's stock still appears inexpensive. The stock is only trading at 28 times Nvidia's projected earnings for the upcoming fiscal year. That's not at all horrible. The AI market's skyrocketing valuations are being compared to the internet's heyday in the late 1990s. Some important details are missed when comparing the AI revolution to the dot-com bubble at a superficial level. According to industry studies, the relentless need for AI will drive $7 trillion in new data center buildouts over the next 5 years. In recent years, the S&P 500 and NASDAQ Composite have reached multiple all-time highs, driven by the artificial intelligence AI revolution. A tiny group of businesses are responsible for a large portion of this momentum. Continuous demand for AI propelled Taiwan's semiconductor manufacturing, Nvidia, and Broadcom into the trillion-dollar club. Well-known behemoths like Amazon, Tesla, Microsoft, and Alphabet have all benefited from a fresh surge in investor interest. However, given that prices have reached all-time highs, some investors might be concerned that the AI market is headed into bubble territory. However, a recent analysis from consulting company McKinsey & Company presents an alternative viewpoint, a $7 trillion insight that might change the way doubters perceive AI's future. McKinsey predicts that the capacity of data centers worldwide would almost triple by 2030, increasing from 82 gigawatts at the present to 219 gigawatts at the beginning of the following decade. Importantly, AI workloads will account for about 70% of this growth, with the remaining portion being linked to conventional cloud and information technology (IT) applications. McKinsey estimates that during the next 5 years, capital expenditures to finance this infrastructure expansion might total close to $7 trillion. Companies like Microsoft, Amazon, and Cisco traded at peak price-to-sales (PS) multiples of 30 to 40 during the dot-com boom of the late 1990s. Skeptics claim that certain AI leaders are currently displaying comparable excess indicators, with some selling at higher price-to-earnings (PE) and PS ratios than historical averages. Particularly noteworthy companies with potentially unsustainable values are Tesla and Palantir Technologies. However, certain important distinctions are missed in the comparison to the dot-com period. Many technology darlings had low sales traction, ongoing cash burn, and values based on measures like clicks and user growth during the height of internet enthusiasm. On the other hand, AI is already widely used at the industry level in a variety of sectors, including robotics, autonomous systems, retail, cybersecurity, and pharmaceutical research. Furthermore, according to McKinsey's statistics, businesses may anticipate steady cash flow as long as data center expenditures continue. Simply said, the income and profits made by businesses driving this faster change are probably going to transfer into long-term premium valuations as AI infrastructure keeps growing quickly. Hope, which can be ephemeral, was the main force behind previous booms in history. On the other hand, ongoing investments in servers, chips, networking equipment, and energy-efficient systems are focusing on the next generation of goods and services that can be evaluated and compared to economic expansion. The impending $7 trillion investment is the first wave of an infrastructure supercycle that is changing entire countries, not a hint of a bubble. Stated differently, this serves as the basis for the upcoming technology plan. The lesson for investors is obvious. Although there will always be volatility, AI's structural demands are set in stone. At the core of this demand are semiconductor designers and manufacturers, cloud hyperscalers, and energy innovators who are well-positioned to benefit from significant secular tailwinds in the years to come. When seen in this light, today's investments are the first steps in a story of historic growth that is still growing. Mega-cap AI equities continue to be among the most alluring buy-and-hold options for long-term investors amid the current boom in AI infrastructure. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community, where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
The pathway getting to AGI, having the super intelligence, clearly what that next revolution is. But to me, there are some companies that have very deep pockets that have been slightly less active than others in terms of some of these collaborations and partnerships, and namely Meta, Mark Zuckerberg, who's been also cozying up to the US president, so trying to play the politics of the day. Maybe Amazon you could throw into the mix as well. And of course, Apple. How do you think about whether these three companies and others will be dragged into this partnership collaboration world?
Look, I mean, it's an AI arms race that's happening, right? So do they actually go down this path or another, or do they join forces? Like, I believe Apple and Google ultimately going to join forces when it comes to AI, when it comes to Gemini, because that DOJ suit is obviously gone favorable. But look, no big tech company watches from the outside looking in. And I think that's the reality. So in other words, if you partner, if you go out alone, the reality is that this CapEx, it's a CapEx super cycle. And that's going to continue for the next few years, which is why we believe this tech bull market, and we've talked about in your show, I think it goes on for another 2 to 3 years.
Yeah, Dan, it looks like an OPEX supercycle too if you're plugging into the hyperscalers. And let me ask you about Intel, because the fortunes of this company have changed overnight thanks to President Trump. All the different deals coming in from SoftBank to the other backing of the company from other big tech names, and Nvidia. I want to ask you about how this changes investing, because I think the market was picking the new chip winners, but now we have an old chip winner that's come into the mix. Is it better to play a basket of stocks when it comes to chips, or would you just buy single names?
Look, I mean, that's why we have our Ives AI 30. I don't think you could just own one name. Like, look, in 2023, 2024, no matter who I met, where in the world, it's like, okay, you have breakfast, lunch, dinner, and you buy Nvidia stock. That's what you do. But now it's spread. Look, you look at Intel, I mean, they got a lifeline, right? It was a pop the champagne moment in terms of not just getting from the US government backing, but of course Nvidia, because now it brings them into the AI game. But I think it just shows you could have some old school companies. I mean, look at Oracle. If you go back a year ago to where it is today, but it shows the install bases. That's why this is really now, it's new rules of the game. And I think you look at innovation, that's going to separate the winners from the losers.
Dan, we've got about 30 seconds left. Is there anything about the valuation of Palantir or OpenAI, obviously different sides of the private-public divide, that scares you?
Nothing. It doesn't scare me because I think the street is underestimating where growth is. And I've always said, if you look at just valuation over 1 year, you've missed every transformational growth stock the last 20 years, right? And that's the bears, when they're in hibernation mode, they don't see that in the spreadsheets. And that's why I think Palantir, $1 trillion market, next 2 to 3 years. They're playing chess, everyone else playing checkers.
Markets managing to put geopolitics to the sidelines to a large degree, and AI remains in focus. I suppose we have reason to go a leg higher with those micron numbers. AI very much still in the driving seat.
I think so. There are a couple of themes going on. Of course, there's the Ukraine story. There's the looming threat of a shutdown in the US. But absolutely the main driver is AI at the moment. And I know a lot of markets have spent the last month or so wondering about whether AI is in a bubble or even for much longer. But as a common refrain of this segment is, if it is a bubble, you don't fight bubbles. That is the quickest way to lose your job in markets. If it's a bubble, you identify it, you ride the early stages. We may be beyond the early stages, but you wait for it then to blow up first, and then you can get on the kind of blow up very easily after the fact. You don't need to try preempting it. At the moment, I don't see why the AI bubble would pop soon. The earnings are going to continue to come strong. It looks like third quarter earnings will be very positive, which we'll get next month, which means the very earliest that we'll see the AI bubble pop is fourth quarter earnings that we're going to get at the start of next year. And it may not even be then. So I think it's more likely that something else derails, as some kind of curveball or black swan, rather than the AI bubble popping. That's just an overvalued market that will crash a long way if we get a negative catalyst, but not the reason to be negative.
Can we have an expected black swan? What kind of black swans are we thinking about?
I mean, the whole point of a black swan is we're not anticipating it. But obviously, given the administration in the US and their willingness to jump in unprecedented ways across all policy fields, you'd have to assume that's the location where some kind of black swan might come from markets. But by definition, no, I have no anticipated black swan. I don't know what it is.
You really get an analysis of the insatiable demand of investors into the AI data center story. But are they starting to question ultimately whether we can meet that insatiable demand, whether funding is there in the longer term?
No, I think it's quite the opposite. Investor enthusiasm is only growing. If you look at one of our ETFs, BAI, it's an actively managed AI ETF. It's brought in over $5 billion this year and is now the largest AI ETF in the United States. And a lot of the exposure that it is providing to investors is around that digital infrastructure layer, the hardware producers in the semiconductor space, the digital infrastructure owners, some of the data owners that are becoming really valuable in this explosion of AI models. And so there's a ton of investor enthusiasm. And I think there's a lot of expectations that revenues will match the expenditures, if not exceed them in the next several years.
But how much should we get comfortable with companies like Nvidia basically plowing their own revenues of today into hopes of revenue of tomorrow, basically funding their end clients?
I think it's beyond comfort. This is a necessity for some of the leading technology companies. They have a tremendous moat because they have low cost of capital. They have tremendous access to dollars. And they're able to really kind of leverage their own strengths, which is if you look at a semiconductor company, owning GPUs, owning this manufacturing process is really valuable in the semiconductor space. That's the shortfall that's needed by large language model developers. So this investment across the industry makes a ton